Why is silver trading at two completely different prices right now? Something is broken in the system. Tonight, the London Open is about to force a reality check. We discovered a rare anomaly that usually happens right before a massive move. Is the market rigged, or is it running out of metal? The proof is in the charts. Help us expose the truth. Please subscribe and like the video. Don't skip a second of this story. The London Silver Fix takes place twice every day. 5 major banks join a conference call to set one price for the whole world. This benchmark guides miners and industrial buyers everywhere. Think of it like a thermometer reading the temperature of the silver market. But recently, a dangerous fracture appeared. The gap between the morning price and the afternoon price is widening fast. In a healthy market, these prices stay very close. Now, we see dollar-wide swings. This exact pattern happened in March 2020, just before silver exploded in value. Tonight is critical because the same warning sign is flashing again. The fix works like an auction. When there is enough metal, the banks agree quickly. But when supply is tight, the auction stutters. It takes more rounds to find a price. If the banks hesitate tonight, it proves the market is broken. When the system cannot find a price easily, it usually means the real price is about to move violently. Paper silver and physical silver are splitting apart. On futures exchanges, you can buy a 1,000-ounce contract with a mouse click. But try taking delivery of that metal and suddenly things get complicated. Warehouses report delays, premiums spike. The paper says $30, but the coin shop wants $35. This gap is like a rubber band stretching. In 2008, it stretched so wide that physical silver cost 40% more than paper contracts. People holding paper discovered they owned promises, not metal. The same disconnect appeared before the 2011 run to $50. Paper stayed cheap while real silver disappeared from shelves. Right now, COMEX shows millions of ounces available, but dealers report 3-week waits for basic bars. Mints can't get blanks. Refiners work overtime but can't meet demand. The paper market says there's plenty of silver at this price. The physical market says there isn't. When these two markets disagree this strongly, history shows the physical market wins. Paper can print infinite contracts. Metal can't. COMEX silver vaults show a dangerous pattern. Registered silver, the metal actually for sale, keeps dropping. From 150 million ounces to under 40 million in 18 months. That's like watching a gas tank needle fall while driving through the desert. Eligible silver still sits in vaults, but owners won't sell at these prices. They're waiting. In 1979, registered silver hit similar lows right before the Hunt brothers pushed prices from $6 to $50. The setup looked impossible until it wasn't. Major banks are moving metal from registered to eligible status. They're pulling supply off the market without announcing why. JP Morgan's vault alone shifted 30 million ounces last quarter. When the biggest players start hoarding, smaller players should pay attention. The mystery is timing. How low can registered inventory drop before the market panics? In 2011, it took a drop below 30 million ounces to trigger the squeeze. We're approaching that line again. Each delivery month drains more metal. The tanks are running dry, but nobody knows exactly when empty arrives. Shanghai silver trades at different prices than London silver. Usually the gap stays small, maybe 50 cents. Traders buy cheap in one city, ship the metal, and sell high in the other. This arbitrage keeps global prices aligned. But Shanghai premiums just hit $3 over London. That's a massive profit opportunity, yet nobody's taking it. Why? Because getting physical silver out of London vaults has become nearly impossible. The metal exists on screens, but not on loading docks. In 2020, this same pattern emerged. Shanghai paid huge premiums while London stayed artificially low. It lasted until March, when London prices exploded upward to match Asian reality. The arbitrage window slammed shut overnight. Here's what bothers traders. Freight costs explain maybe $1 of premium. Currency differences add 20 cents. That leaves $2 unexplained. It's like seeing smoke, but no fire. Something is burning behind closed doors. Chinese buyers know something London hasn't admitted yet. They're paying tomorrow's price today. Strange things happen in the hour before London opens. Massive sell orders appear, push prices down, then vanish before execution. It's like watching ghosts trade silver. These phantom orders scare real buyers away, creating artificial weakness right when Europe wakes up. The pattern is precise. At 7:00 a.m. London time, someone dumps paper contracts worth millions of ounces. No rational seller announces their presence this loudly. It's like yelling fire sale in an empty store. By 7:45 a.m., these orders disappear. The damage is done. Prices open lower. Traders call this painting the tape. In 2011, regulators caught banks doing exactly this before the London fix. The fines were paid, but the behavior continues. Same timestamps, same size orders, same disappearing act. What's different now is frequency. These pre-open attacks used to happen monthly. Now they're almost daily. Someone needs silver prices lower before London opens. The urgency suggests they're running out of time. 3 times in modern history, silver exploded higher. Each time, the setup looked similar to today. In 1980, the Hunt brothers pushed silver from $6 to $50. Physical shortages met paper manipulation until the dam broke. In 2011, quantitative easing and Greek debt fears drove silver from $18 to $48 in 6 months. Again, physical demand overwhelmed paper supply. In 2020, pandemic fears and stimulus spending launched silver from $12 to $30 almost overnight. Each explosion shared 3 ingredients: tight physical supply, loose monetary policy, and widespread distrust of paper assets. Today has all 3. Central banks print money while mines produce less silver. Investors question whether their ETFs hold real metal or just promises. But one piece is missing: the trigger. In 1980, it was the Hunt brothers buying everything. In 2011, it was European crisis. In 2020, it was pandemic panic. What's today's trigger? Maybe it's not an external shock. Maybe it's the system finally admitting what the inventory numbers have been screaming for months. Tonight's London Open will reveal the truth through specific signals. Watch the bid-ask spread first. Healthy silver trades with 10-cent spreads. Stressed markets show 50-cent gaps. If spreads blow out past $1, the market is screaming. Second, monitor the fixing process itself. Normal fixes take 2 rounds of phone calls. Stressed fixes take 5 or more rounds as banks struggle to find balance. Each extra round means deeper problems underneath. Third, check lease rates, the cost to borrow silver for short selling. Normal rates stay below 1% annually. When rates spike above 3%, it means nobody wants to lend metal. That happened right before every major silver squeeze. Finally, watch for backwardation, when spot prices exceed future prices. This breaks normal market logic. It means immediate demand overwhelms expected supply. In healthy markets, futures cost more than spot. When this flips, something fundamental has changed. If tonight shows wide spreads, extended fixing, high lease rates, and backwardation simultaneously, the paper market is losing control to physical reality. The evidence points toward a reckoning. Registered inventory approaches critical lows while Shanghai premiums signal global shortage. Pre-open manipulation grows more desperate as physical demand overwhelms paper supply. Every historical precedent suggests the current price disconnect cannot survive much longer. Tonight's London Open becomes the stress test. If the fixing process breaks down, extended rounds, blown spreads, spiking lease rates, it confirms what inventory numbers already whisper. The paper silver market has promised more metal than actually exists at these prices. The pattern isn't subtle anymore. It's screaming through widening gaps, phantom orders, and vanishing registered stock. When London opens tonight, watch for the system to finally admit what the data has been saying all along. The real silver price is somewhere else entirely. The question isn't whether repricing comes, it's whether tonight marks the moment the market stops pretending otherwise.